Index weighting methods determine how individual securities influence the overall value and performance of a market index. The program explains that market indexes are statistical measures designed to represent the performance of specific groups of securities, such as stocks or bonds. Because indexes serve as benchmarks for portfolio management, performance evaluation, and passive investing, the weighting methodology significantly affects index behavior and risk characteristics. Different weighting approaches allocate influence differently among constituent securities, resulting in varying exposure to company size, price movements, and market concentration. Analysts and investors must understand index weighting methods because they influence diversification, return patterns, volatility, and the effectiveness of investment strategies linked to benchmark indexes. Price-weighted indexes assign weights based on the share prices of constituent securities. In this method, companies with higher stock prices have greater influence on index performance regardless of their actual economic size or market value. The program identifies the Dow Jones Industrial Average as a classic example of a price-weighted index. Price-weighted indexes are relatively simple to calculate, but they may produce distortions because stock price alone does not necessarily reflect company importance or total market capitalization. Stock splits also require adjustments to maintain index continuity. Analysts recognize that price-weighted indexes may overrepresent companies with high nominal share prices even when those firms are smaller economically than lower-priced companies. Market capitalization-weighted indexes assign weights according to the total market value of each company's outstanding shares. Larger companies therefore exert greater influence on overall index performance. The program notes that capitalization-weighted indexes are widely used because they reflect the relative economic size of constituent firms and require minimal rebalancing. Examples include the S&P 500 and many global equity benchmarks. Capitalization weighting also aligns naturally with passive investment strategies because larger companies receive proportionally greater portfolio allocation. However, this approach may increase concentration risk because a small number of large firms can dominate index returns, especially during periods of strong performance among major technology or financial companies. Equal-weighted indexes allocate the same weight to each constituent security, regardless of company size or stock price. This method reduces concentration risk and increases exposure to smaller companies relative to capitalization-weighted indexes. Equal-weighted indexes often require more frequent rebalancing because market price changes continuously alter security weights over time. The program explains that equal weighting may improve diversification but can increase transaction costs because of higher turnover. Equal-weighted indexes may outperform capitalization-weighted indexes during periods when smaller companies perform strongly, but they may also exhibit greater volatility due to increased exposure to less stable or less liquid securities within the index composition. Fundamental weighting methods assign weights based on accounting or economic measures rather than market prices or capitalization. Examples include weighting by revenues, earnings, dividends, book value, or cash flow. The objective is to reduce potential distortions created by market overvaluation or speculative price movements. Fundamental weighting attempts to align index composition more closely with underlying business fundamentals rather than investor sentiment. Analysts and portfolio managers may use these indexes to pursue factor-based investment strategies or improve diversification. However, fundamental indexes often require more frequent adjustments and involve greater complexity than traditional capitalization-weighted approaches. The choice of fundamental variables can also significantly influence index performance characteristics and sector exposure over time. Understanding index weighting methods is essential because weighting choices directly affect portfolio risk, diversification, and investment performance. Different methods produce varying exposures to large cap companies, smaller firms, value factors, and market concentration. The program emphasizes that no single weighting approach is universally superior because each method involves trade-offs between simplicity, diversification, turnover, and representation of market structure. Analysts evaluate weighting methodologies carefully when selecting benchmarks, constructing portfolios, or analyzing passive investment products such as index funds and exchange-traded funds. A strong understanding of index weighting methods enables investors to interpret benchmark performance more accurately, evaluate investment strategies effectively, and make better portfolio allocation decisions within global financial markets.